It's Wednesday evening, October 21st, and it's time for the weekly swing trading video. Hello, traders. The market has given us a lot of excitement in the last week. Boy, got a lot to recap, so let's start with the market analysis and see where we're at. So we had this nice little pullback here off of a buying climax that we properly identified. The market pulled back. Everything was looking good. We were waiting for that low to be established. Downward sloping trend line, breakout to the upside, happened very, very quickly. And we started trying to get some bullish put spreads off here. As the market rallied above the 50-day moving average, we progressively tried to get those spreads off, and we were able to get into quite a few positions. The underlying premise for the trades was that we would focus on stocks that were about to report earnings, companies that tended to rally into the earnings announcement, and we would sell out of the money bullish put spreads on those stocks on the notion that we wouldn't see any heavy market selling until the election. So all of our spreads were going to expire on October 30th or before, and we had about 7 bullish put spreads on. Everything seemed to be going well. We had this nice little rally here. Things got a little bit overextended. We had some true gaps here, which I've mentioned, where the market gaps up and the low of the day on that gap is higher than the prior day's high. Well, we had 3 of them in a row, and this overextended condition saw a little bit of profit taking. So the market started to pull back a little bit. We have this upward sloping trend line right here that you can see visually, and we dipped below it one day, but that day closed on the high. So nothing too alarming, nothing to get me excited and tell me that things are headed the wrong way. But then Monday, this long red bar right here was a definite warning sign. Now, I also believed that as long as the market got its next fix, its next stimulus bill, that it wouldn't really care if it came before the election or after the election. The election's only a week away, so the market can wait a few weeks, right? Not so. As it turns out, the only thing, in my opinion, keeping a bid to the market is not earnings. Earnings are expected to be down 20% in Q3 year over year. So it wasn't earnings. It was the fact that there might be a stimulus bill before the election and that politicians were talking and that those talks were very, very progressive, and that kept sellers at bay. But as it turns out, there is some natural selling pressure taking place. I believe that's because asset managers are starting to sell some of their positions and they are reducing risk into the election. So the only thing that was keeping the market up was the fact that there might be a stimulus bill. So there were buyers out there thinking that, yes, this could happen any day now. In the absence of a stimulus bill before the election, I believe that we are going to see some selling. And Amy Coney Barrett is going to be confirmed next week. So I personally believe that if a deal does not get done by Friday, it's not going to happen before the elections because the Democrats are going to be very, very upset with the Republicans pushing through this confirmation, and they are not going to be in a mood to do anything before the election. There's also statements that we've seen by both sides that if a deal doesn't happen by Friday, they won't have enough time to get the deal done before the election. So we're really kind of hitting a hard timeline this Friday. And in his comments today, Steve Mnuchin said he's pretty happy with the way negotiations are going. Well, that's not a resounding endorsement of what is going on. So I believe that we may not see a stimulus bill before then. We do need the stimulus bill. We're starting to see coronavirus cases increase domestically. A lot of major metropolitan areas are really starting to lock down again. All of Europe is locked down. That is going to weigh on economic activity, and we're going to see that in the next few weeks, next couple of months for sure. Those numbers are going to start bearing out in the economic data points. So We need that stimulus bill, and we need it right now. I don't know that we'll get it. If we don't get it this week, we can expect some heavy selling. So, what did we do? We erred on the side of caution, and I advised all of you to buy back our bullish put spreads that we currently had out there. The good news is that we were able to exit all of our positions at a break even, or in some cases, even make money on it. So we were able to dodge the bullet. The stocks that we were in are still very strong. They held up well. That's why we were able to buy those spreads back. Time premium decay had already helped us. So they were good positions, but we don't want to be managing losses. If this bill doesn't get passed this week, I think it's going to get pretty ugly. So after that long red candle, what happened? Well, typically you're going to see a bounce the next day. Well, the market tried to bounce. This was Tuesday, and you can see how the entire day it drifted lower and lower, closing on its low. Long tail above body. Today, exactly the same type of price action. Market tried to get going. In fact, it almost got up to the opening price from that long red candle. And throughout the day, we saw persistent selling. So let's bring up that 5-minute chart. Let's take a look at the action. And here you can see how the market tried to rally, made a high there, lower high there. You can see this longer term downtrend line is still intact. This is just something that I drew for my own purposes. I highly recommend that you draw these trend lines for your own purposes. If I use the zoom out tool, you can see the trend line that I'm kind of using as a gauge. If that trend line stays intact, I'm going to continue to be short. In fact, I do have a half position of futures currently open on the short side. So I'm a little bit bearish in here. I do not like what I've seen in the market. I do not like the fact that the market has been closing on its low the last couple of days. These long tails above body tell me that the selling pressure is still there. Again, I feel the only thing keeping the market treading water here above the 50-day moving average is the fact that we may see a stimulus bill this week. I'm not going to hold my breath waiting for that to happen. So I hope that Washington, D.C. gets its act together, but I'm not counting on it. If it doesn't happen, this 50-day moving average is going to fail easily, and who knows, we could even test the 100-day moving average before the election. I also feel that the election outcome may not be known for a few weeks. Lots of mail in ballots, lots of issues statewide as far as people being able to cast votes, a lot of problems with those mail in ballots as well. The timeline as far as when they need to be submitted and how long is it going to take to count them. If we don't know the election outcome for weeks, the market is not going to like that uncertainty. You're going to see a lot of civil unrest. And if you can imagine, it's hard enough for them to get a stimulus bill done now. Well, what's going to happen in D.C. when nobody even knows who's going to be taking office? It will be a complete mess. So that's why we're going to err on the side of caution. We're only going to have one position open. I may add another position next week. I have to see how everything is shaping up. And I'll give you a little peek at what I'm thinking of doing. So let's take a look at our positions last week. I do have a bearish bias, but I don't want to be blindsided by a stimulus bill that gets passed and then the market rallies. So let's take a look at everything that we had on last week. We had our Abbott calls. We had sold a Abbott bullish put spread for 20 cents. That expired worthless last Friday. That was good. And you can see that right here, the 104, 103. We got 20 cents for that. And then we did a bullish diagonal where we bought the 110 calls that expired this Friday, October 23rd, and we sold a shorter term out of the money call against that. That was the October 16, 115 calls, and we did this debit spread for $2.70. So the way that I view that trade is we got 20 cents on the bullish put spread and we paid $2.70 for this. So our net cost for those Abbott 110 calls was $2.50. As you know, on Monday night, I said, let's get out of this. They announced earnings before the open today. Stock did not react favorably to it. But that doesn't matter. All we were doing was we're playing on the fact that the stock has a tendency to rally into the earnings announcement. It was well on its way on Monday. I thought we had a really nice trade going, but then we had this price action in the market that really kind of spoiled the entire setup. So let's bring up Abbott. Let's take a look at what it did. And here you can see that was the price action Monday. It started to get up to that high of 111 and things looked really good. If we had a bullish market day, I think we would have even hit our price target the next day. However, I did say to sell those calls on Tuesday for $2. We were able to get out of the trade and we lost 50 cents on the trade. We had $2.50 invested in it, so we lost 50 cents or 25%. So in essence, we need to hit one of our bullish put spreads to offset that loss. So I'm going to put up the other trades and we can take a look at those. AMD, we were able to buy back for a small profit. Again, I'm going by everything that was posted in the chat room. I really rely on members in the chat room, most of who do all of these bullish put spreads, to let me know when they're able to exit the trades. And given all of those posts, I can get a very clear perspective on whether or not we're able to get out of the trade. So AMD, I'm hearing that we were able to make a little bit of money on. DGOG, not many people were able to get in on that trade initially, but that we were able to reel in. CLX, we were not able to reel in. So let's take a look at that trade right now. I think we're going to be in pretty decent shape on this, and I'll explain why. So we had the stock rallying above the 100-day moving average and the 50-day moving average. That was beautiful. That was the underlying premise for the trade, plus the fact that this stock has a tendency to rally into earnings. Well, right about in here, we had a brokerage firm downgrade on the stock. They lowered their price target on the stock to, I believe, $225, which is still up here. That's not bad. They went from a buy to a hold. So it wasn't a huge downgrade, but it did weigh on the stock a bit. You can see how it's been floating lower on that news. Plus, you've had market weakness as well. But the reason that I think it's going to stay afloat is if you look at Procter & Gamble, it's up near the high. It had a nice rally early. It pulled back during the course of the day. This is a consumer staples stock. So consumer goods, these tend to be stocks that attract buyers during times of uncertainty because these stocks have very stable revenue. And if I take a look at CLX and what it did today, you can see that it started to find some support on a weak market day. We'll go into the 5-minute chart. We'll take a look at it. And there you can see there's the opening. Nice little rally here. Got a higher low double bottom. Nice little rally here. Market pulls back later in the day and the stock gives in a little bit, but still a higher close. I believe that the stock's going to continue to move higher. Now, these options expire on October 30th. If I start to see some relative weakness creep back into the stock, I will send instructions and we will close the trade down. But we do have that bullishness going into the earnings announcement. We also have coronavirus spreading globally, domestically, and globally. That is going to be good for their products because they sell bleach. So obviously that's used as a disinfectant. I think that this could help CLX. On this particular trade, we are short the October 30th 212.50 puts and we're long the 210 puts, and we did that spread for a credit of 45 cents. Here are your standing instructions. I want to buy that spread back for 45 cents. Good till cancel. So we're going to try and scratch that trade. That is our only open position as of right now. Down to the next trade, PDD. We were able to make money on that. Boy, that stock really took off today. That was a really nice one. But again, we needed to err on the side of caution. You can see that big pop right there, and you can see how strong the stock has been. So that was a really nice one. MSFT, Boy, that was a tough one for us. I didn't know if we'd be able to get out of that one or not. Yesterday's rally really helped us. We were able to get out of that at 40 cents. And here you can see, even if you weren't able to get out yesterday, today, given the time premium decay, you would have been able to get out of it fairly easily because these options expire this Friday. So time decay is really whittling away at that position, and those options are still out of the money. McDonald's, that's another one that we were able to make money on. Again, not a lot of money. We may have made 4 or 5 cents on the spread, but we made money on it. And here you can see how well the stock held up even during the market decline. And you can see how it rallied yesterday on that gap higher. So McDonald's, we were able to make a little bit of money on. SWKS, we only had that trade on for a day, and we were able to exit that as well for a 20-cent debit. That brings me to our trade. We're going to be doing a diagonal spread on gold. I want to buy some longer term options on gold, and I want to sell some shorter term options on gold. It'll be very similar to the Abbott trade that we did a week ago. So let's go in and let's take a look at that. First, let's take a look at gold, and let me give you the underlying premise behind the trade. So, why do I like gold? Well, just from a technical perspective, here are the things that I like about the current setup. I'm going to draw a trend line from that high, and I'm going to drop it like that. But actually, I want a different starting point. When I draw my trend lines, this one will work just fine to illustrate the point, but I like to grab as many points as I can, and this right here might actually grab a few more points, but the premise is the same. The stock has started to break out above this downward sloping trend line. Earlier this year, you can see the steady interest in gold. Look at how much it rallied, reaching a new all-time high at 194 on GLD. That'd be 1940 on the gold futures themselves. You can see here how gold is trying to get through that 50-day moving average right now, and it's right on it. So it gapped higher today. It found resistance there. I hope that it still has that resistance point tomorrow because it's going to allow us to get into this trade. We also have an upward sloping trend line right here. And so that's also working in our favor. And we have the 100-day moving average just below. So we are going to be leaning on that 100-day moving average when we set the trade up. So if I look at this, where might gold possibly go? And why might it go higher? Well, I believe that the stimulus bill is going to happen one way or the other. Well, as soon as those stimulus bills hit, that is the printing press that weighs on the US dollar. The more dollars there are, the less the dollar is worth. And you can see how our stimulus bill from earlier this summer started that massive, massive run up in gold. So I look at gold as the anti-dollar. When the dollar goes down, gold goes up on a relative basis. And it doesn't matter to me if Republicans or Democrats win the election, both parties are going to be printing dollars. They're going to be printing even more dollars if the Democrats win because they're looking for a bigger stimulus bill. So this position would benefit even more if the Democrats win, but the differences are pretty minor now because the Republicans have been steadily coming up and they're looking at a $1.9 trillion stimulus bill right now anyway. So either way, lots of dollars are going to be sloshing around. Now, I want to also mention that gold is not something that goes up when the market goes down. It is resilient relative to market declines, but it is an asset. And when people start selling their assets, gold is one of the last remaining ones that they will sell, but eventually they start looking at their portfolio and they don't want to sell things that have gone down dramatically. They want to sell things that still have made some money or are still holding their value. And so if there's a market decline that starts to really accelerate, let's say that the market decline is 4 weeks old, then you're going to start to see some selling pressure in gold as investors start to liquidate all of their assets. And a big market decline would also start generating margin calls. Well, if you're having to satisfy margin calls, you need to raise cash, so you sell everything. I'm not looking for a massive market decline. I just wanted to explain to you how gold works because I've talked to so many investors in the past who feel that, oh, the market's going to go down. I'm going to buy gold and gold is going to go up when the market goes down. That's not how it works. And that's not why I'm taking this trade. I'm taking this trade because I'm counting on politicians printing money like mad. That's why I believe gold is going to go up. So let's take a look at how we might structure this trade. I've already given you one clue. You know that I love to lean on these major support levels right here. So the 176 level is certainly one that I'm going to be looking at. And I'd like to sell the 176, 171 bullish put spread. And I'm going to be doing this in November. So obviously when I'm selling premium, I always want to make sure that I'm selling premium near term to take advantage of accelerated time decay. So we're going to be selling that bullish put spread, and I'm going to show you the staged order entry screen. And here you can see the trade. We're going to be selling one GLD November 20th. So this is the normal option expiration cycle. We're going to be selling the 176 put and we're going to be buying the 171 put. So there is a $5 spread between these strike prices and we're going to be taking in a $1.20 credit for this. So we'll go to the trade screen and we'll put that up first and we'll go back down to, I'm going to reset this so we can take a clear look at it. So we're again selling the 176 put and we're going to be buying the 171 put. So if I click on that bid and I click on the ask of the 171s, you'll see that that is currently 119 bid offered at 124. We're going to be trying to get a $1.21 credit for it, good till cancel. So let's take a look at the other side of this, and I'm going to reset this so we can remove that. We're also going to be doing a diagonal spread. We're going to be selling the November 20th 190 call, and we're going to be buying the January 15th 86 call. So we're going all the way out to January normal option expiration, and we're going to be buying that 186 call, and we're going to try and do this diagonal spread for $3.55. So let's load that trade up and see what it looks like. So go down to the January 15th. Let me get to that expiration. And there we've got January 15th loaded. And we're going to be buying the calls there. And we're buying the 186 strike price. And in November, we're going to be selling the 190 calls. And we'll load that part of the trade up. We'll click on that bid, and you can see that that spread is 346 bid, offered at 359. So I believe that we'll be able to get this trade off, all things remaining constant, assuming that gold does not move overnight much. I'm going to be looking to get this part of the spread done for $3.55. So let's take a look at the spread one more time. On GLD, we're going to be buying the January 15th 186 calls, and we're going to be selling the November 20th 190 calls. So let's say that gold rallies above 190 by expiration in November. What's going to happen? We'll be very, very happy with this because the 190 call or the 186 calls in January are going to always carry some time premium because they'll have 2 months left before expiration. So they won't be trading at parity, but let's say that they are. This spread would be worth $4. Well, what did we pay for the spread? We had $3.55 that we're paying for the diagonal, and we had a $1.20 credit that we got on the bullish put spread. So our net cost on this is $2.35 on this diagonal. Well, if it can be worth $4, that's going to represent a really nice profit of about 50%. But I know that those January calls are not going to be trading at parity. They're going to have a lot of time premium in them, so we'll make something north of that type of return. Let's look at another scenario. Let's say that gold continues to grind higher. And let's say that it just starts to float up maybe to 186 or so, and those options start to get in the money. Then what happens? Well, our 186 calls that expire in January will increase in value, and our November calls are going to expire worthless, plus our bullish put spread is going to expire worthless. So we're going to have collected all that premium, and our net cost on those January 186 calls is going to go down to $2.35. That's a pretty nice trade. We'll be able to make really decent money in that scenario, maybe even 100% winner. So let's take a look at another scenario. Let's say that gold goes down to approximately $176 down to this 100-day moving average, and it finds support here, but it does pull back into November. What happens then? Well, our net cost on those 186 calls in January, again, that's going to be $2.35. Given that they're currently trading at about $5.05, I believe that they'll lose value, but this should be pretty close to a break-even point. So I feel that we've got time decay working in our favor. I feel that we have politicians who love to print money working in our favor. I'm fairly certain that we're going to see another big stimulus bill and that the dollar is going to continue to move lower. And I feel that that gold is going to continue to move higher on that news. So that's the premise behind the trade. I only have one trade that I'm going to highlight this week because I want to be sidelined. We just spent a lot of time and effort getting into our bullish put spread positions, and we spent a lot of time and energy exiting those trades. We made a little bit of money overall on those, but we did have a loser on Abbott. The Abbott loss did not offset the gains that we made on our other bullish put spread, so I'm not going to say that even remotely. But we're on the sidelines. We're in cash. We've got a lot of uncertainty coming up. I haven't discussed Brexit. That could also weigh on the market. We don't know what's going to be happening there. But the election here in the U.S. is certainly going to be a potential speed bump that we have to get through. And the fact that coronavirus is spreading and spreading quickly is also a concern. Now, there is some good news. I don't want to leave on a negative note. AstraZeneca has said that they're going to have a vaccine. Mass distribution is expected by Christmas. So hopefully the vaccine works. Hopefully there's some light at the end of the tunnel. If everyone is going into cash right now ahead of the election to see how everything plays out, that could leave a lot of money on the sidelines, and that could also fuel a possible rally into very late year end, possibly into the beginning of 2021. So it's not all gloom and doom. This is just a very good time for us to be on the sidelines, to wait and evaluate. And I think this GLD position could actually work for us while we're waiting on the sidelines. I wouldn't go gangbuster on this position, meaning I wouldn't allocate 50% of your account or something crazy like that, but use your normal trade allocation that you would use and expect that we're going to be doing a lot more trading after the election. That's all I've got for you tonight. Thanks, everybody. If you're watching this video on YouTube, I record this for my members on Wednesday night. I do not release the video to YouTube until a day or two later. I want to give my members a chance to get in. But in this particular instance, because it's a longer term trade, take a look at this trade. I think it still might be viable even a few days later because those spreads are not going to collapse instantly. I think you'll still be able to get in it and follow the instructions that I provided for everyone. If we need to make any adjustments to the position, I will send an email out. If I see anything that changes that looks attractive, I'll do a quick video and I'll send out an email. We'll be able to take advantage of opportunities as they present themselves. So again, thanks everyone for watching. Good luck with your trading. Thank you for watching this YouTube video. I'm Pete Stolzers and I'm going to keep the trade ideas coming along with lots of education. So make sure to subscribe to the channel and please turn on your notifications so that you never miss another trade. If you like the content, please give it a thumbs up. I've loaded 2 other videos that I think you're really going to enjoy. Stay tuned. We'll see you soon.